buy, borrow, die. You may have heard the phrase before, but most people assume it is a statement about wealth. It is not. It is one of the most powerful tax strategies ever used by the wealthy, and it is completely legal. Billionaires like Jeff Bezos, Elon Musk, and Mark Zuckerberg have used it to reduce their tax bills to near zero while building fortunes worth hundreds of billions of dollars. For most people, earning more means paying more in taxes. For those who understand how to leverage the tax code, earning more opens up more opportunities to reduce what they owe. This is the strategy that makes that possible. Today, you will discover exactly how buy, borrow, and die works at every stage, why the tax code rewards those who use appreciating assets instead of earned income, and how the wealthy pass generational fortunes to their heirs with almost no capital gains tax liability. Welcome back to Finance Insight in High Def, where we give insight into proven financial principles and how we can use them to improve our daily lives and build towards a better financial future. If you are new here, consider a like and subscribe as we dive into the 8 principles on how the buy, borrow, and die strategy allows the wealthy to legally eliminate their tax bills. Principle 1. The appreciating asset that builds wealth without taxes. The first principle is recognizing that the type of asset you hold determines how much of your wealth the government can reach. Earned income from a job or a business is taxed immediately. Appreciating assets grow in value without generating a tax bill until you sell them. Appreciating assets are investments that tend to rise in value over time. These include stocks, real estate, precious metals, and private business equity. When your Apple stock rises from $100,000 to $200,000, you do not owe capital gains taxes on the $100,000 gain until you sell the position. This is the foundation of the entire strategy. Billionaires can accumulate billions of dollars in unrealized gains every single year without triggering a single dollar of tax liability. The wealthy do not focus on earned income. They focus on portfolio income from investments, which provides the most favorable tax treatment available in the code. Principle 2. The unrealized gain that creates billionaire wealth tax-free. The second principle shows why unrealized capital gains are the most powerful wealth-building mechanism available to investors at every level. The government taxes what you realize, not what you accumulate. Jeff Bezos built a net worth exceeding $150 billion primarily through Amazon stock appreciation. For years at a time, he paid no federal income tax on that growth because he did not sell the shares. Elon Musk's wealth grew by tens of billions in single years without triggering income tax because Tesla and SpaceX equity is unrealized until a sale occurs. This is not a loophole. It is the intended function of the capital gain structure. The wealthy exploit this by never selling. They hold indefinitely, allow the assets to compound, and find other ways to access the cash they need. That other way is step 2 of the strategy. Principle 3. The borrowed capital that converts wealth into spending power. The third principle explains why borrowing against assets rather than selling them is the most tax-efficient way to access wealth. When you sell an appreciated asset, you trigger a taxable event. When you borrow against it, you do not. To access capital without selling, you take your appreciated asset to a bank and offer it as collateral. As long as the collateral meets the lender's quality standards, the bank issues you a loan while holding your asset as security. The loan proceeds are completely non-taxable because the government does not classify borrowed capital as income. This is why borrowing is superior to selling for high net worth individuals. Selling $1 million in Amazon stock to access $700,000 in cash leaves you with a capital gains tax bill on the proceeds. Borrowing $700,000 against $1 million in Amazon stock gives you the same cash with zero tax owed on the loan. Principle 4. The collateral that keeps growing while you spend. The fourth principle reveals the compounding advantage that separates borrowing from selling over a long time horizon. When you sell an asset to access cash, the sold portion stops appreciating. When you borrow against an asset, the full position continues to grow. If you sell $700,000 of your $1 million Amazon position, you are left with $300,000 in stock. If Amazon doubles over the next 2 years, that remaining position is worth $600,000. If you instead borrow $700,000 against the full $1 million position, you retain all the stock. If Amazon doubles, that position is now worth $2 million. The difference between those two outcomes is $1.4 million. That is the real cost of selling versus borrowing. Warren Buffett has held Coca-Cola stock in his Berkshire Hathaway portfolio for decades without selling, accumulating tens of billions in unrealized gains while living on dividends and other income streams. The longer you hold and borrow rather than sell, the more powerful the compounding becomes. Principle 5. The loan repayment repayment strategy that sustains the cycle. The fifth principle addresses the question every first-time learner asks. If you borrow against your assets, how do you repay the loans? The answer is that repayment is gradual and multiple strategies exist to keep the cycle functioning. Some investors use cash flow from dividend-producing stocks or rental properties to cover loan payments. Others gradually sell small portions of appreciated assets over time and use those proceeds for repayment. Still, others refinance loans periodically to extend repayment terms or reduce monthly obligations. The key insight is that only a fraction of the loan requires repayment each year. Borrowing $1 million does not mean repaying $1 million in 12 months. As assets continue to appreciate, the loan balance becomes progressively easier to manage relative to the growing collateral. If loan proceeds are invested into cash flow producing real estate, the interest may also be deductible, adding another layer of tax efficiency to the strategy. Principle 6, the Dollar CEO Club that proves the strategy works at scale. The sixth principle demonstrates that the buy, borrow, and die strategy is not theoretical. The wealthiest executives in the world have built their entire lifestyle funding model around it, paying themselves the smallest legal salary while living entirely on borrowed capital. This is known as the $1 CEO Club. Mark Zuckerberg, Jack Dorsey, Elon Musk, and Google co-founders Larry Page and Sergey Brin have all paid themselves salaries of $1 or a similarly minimal amount. They fund their daily lives by borrowing against the equity they hold in their own companies. By paying themselves no meaningful salary, they avoid ordinary income tax at the highest marginal rates. By borrowing against their stock, they access hundreds of millions of dollars in spending power with no income tax owed on the proceeds. Their equity continues to compound. Their tax bill remains near zero. The strategy is not reserved for billionaires. Anyone holding appreciated assets can apply the same mechanics at a proportional scale. Principle 7, the step up in basis that resets the tax clock at death. The seventh principle covers the final and most permanent tax advantage in the buy, borrow, die strategy. When you die holding appreciated assets, the cost basis for your heirs is reset to the fair market value at the time of your death. Every unrealized gain accumulated during your lifetime vanishes for tax purposes. This is called the step-up in basis. If you purchased a rental property for $500,000 in 2005 and it is worth $2 million at the time of your death, your heirs inherit it with a cost basis of $2 million. They owe zero capital gains tax on the $1.5 million in appreciation that occurred while you owned it. Any loans outstanding at the time of death can be paid from life insurance proceeds or estate assets. Your heirs inherit the remaining asset portfolio free of the capital gains liability that would have applied had you sold during your lifetime. The strategy is complete. Assets appreciated tax-free. Cash was accessed tax-free through borrowing. The estate transfers tax-free through the step-up. Principle 8, the estate exemption that shields the inheritance. The final principle addresses the estate tax concern that most people raise when they first encounter this strategy. Estate taxes apply to large transfers of wealth at death, but the exemption thresholds protect the majority of estates from federal liability. In 2025, the federal estate tax exemption is $13.99 million for single individuals and $27.98 million for married couples. The vast majority of people who implement the buy, borrow, die strategy will never approach those thresholds. For those whose estates exceed these limits, trust structures can be used to mitigate estate tax liability and protect a larger portion of accumulated wealth. Some states impose their own estate taxes with lower exemption thresholds, so awareness of state-level rules is important. But the combination of step-up in basis, estate tax exemptions, and properly structured trusts means that generational wealth built through this strategy can transfer almost entirely intact. The wealthy do not just use buy, borrow, and die to avoid taxes in their lifetime. They use it to ensure that the wealth they build outlasts them entirely. If this breakdown of the buy, borrow, die tax strategy has given you insight on how the wealthy legally eliminate their tax bills, share this with anyone who needs to understand that tax law rewards asset holders over salary earners. Hit the like button and subscribe for more insights that separate those who build wealth from those who hand it to the government, the asset owners from the wage earners, and the tax efficient from the tax uninformed. You may also comment down below on whether you are currently using any form of the buy, borrow, and die strategy in your own financial plan and how. See you in the next video.